Okay, it's showtime, folks. I want to welcome everybody to today's event. This is a sneak preview, Q3 earnings. You got John Hopkins here, Tom Bowley going to jump in just a minute so we can get this thing moving along. I want to welcome everybody who's new to Earnings Beats. This might be your first time sitting in on one of our events. We want to welcome you and, of course, welcome all of our wonderful veteran members. We started the company, Tom and I did back in 2004. And we have members who've been with us since we started. That's pretty awesome. Like partners of ours. That's really great. This great screenshot you see is brought to you by Abby, our great assistant. A lot of you folks have been writing in customer service questions and are special with our new ETF service coming up, and you're hearing from Abby. She's just rapid firing. There's so many inquiries coming in about this new service that we're going to unveil next Monday, the model portfolio. That the things are coming in rapidly. Anyways, today's session will be recorded as usual. You'll be able to get a copy of that recording. I think Tom's going to go over some charts today, so you might like to jot some things down and then go ahead and review the recording if you have any questions. By the way, this is a prelude to next week when, I think it's on Tuesday, I think the ETF event's on Monday, the model ETF portfolio, and then Tuesday, I believe, is the event that we're going to be actually looking at Q3 in great depth, where Tom will be looking at some of the companies that are already reported, looking at companies that are coming up. By then we'll have a number of companies that have reported, with thousands more coming up. So that'll be a members only event. Tonight's a sneak preview to give you an idea of what that one will be about. Anyways, that's enough for me. We'll see if Mr. Bowley's in the house. He's got a voice. You there?
I am here. How you doing, John?
Good. Just like these emails coming in rapidly, the webinar's been rapid. We got a couple more coming up next week, and I think that does it for the month. I think. Maybe not, though. You never know.
Yeah, I don't know, but I do know that I'm ready for a break, I think.
Yeah. You got webinar fatigue.
Yeah, there's no doubt.
Okay. Well, I'm going to go ahead and turn it over to you so we can get this thing rolling.
Okay, sounds good. Yeah, I'm actually going through a chart list right now. I'm just kind of numbering the charts. If you are interested in a webinar where a lot of charts are reviewed, then you're going to love tonight's, because really that's all I've got going are just a lot of charts. We're going to look at a lot of different charts companies that either have already reported or will be reporting. And I think probably we're probably good to go. Let me go ahead and we're going to jump right into that in 1 second. But before we do that, I always like to start off all of our webinars with our special. We always have a webinar special. So let me, I know this particular webinar is open to the public. So we've got a lot of folks maybe that are new to Earnings Beats. So I always like to give a little bit of background and show the special that we have. So here, first of all, is just our homepage. Everyone who is in tonight, if you're not already a member of the Earnings Beats Digest, which is a completely free newsletter, no credit card required, unsubscribe at any time. If you're not already a part of this newsletter, you'll be a part after the webinar tonight. So we will make sure that you are entered into our newsletter. The other thing that gets you is we send out recordings to our entire community when we're done. So if for any reason you have to leave early, or if you've signed up and you're in our community and you can't attend live, it's a way for us to get the recordings out to everyone. So you do have that to look forward to. There are really, there are a few things that are that are critical here at Earnings Beats. One is our chart lists where we organize all of our research for our members, and those members who are extra and pro members over at Stock Charts can download our work right into their accounts. If you're not extra or a pro member over there, you can still review all of our work. You just can't download it because you don't have an account to download it into. But we have a 30-day no-cost trial. You pay $7, but then we refund it back to you. So we're literally 30 days at no cost. Stock Charts has a free 30-day trial. If you haven't tried, I would really suggest doing both services at one time, 30 days, and just see what you think after 30 days. But the chart lists are a big part of what we do. We also have some preset scanning strategies that we like to use against our chart list. And then you can see here on our homepage the performance of our portfolios, which it's just blowing the doors off the S&P 500. Most mutual funds, most fund managers really struggle to outperform the S&P 500. 3 of our 4 are killing the S&P 500 since their inceptions. The only one that hasn't is the income portfolio, which is much more conservative. And even that one at this point, since inception now, it's climbing closer and closer. So it's up 18% since May 19th of 2019, whereas the S&P is up 22%. But if you look at these numbers, all of the others have been big outperformance. I will say, and I'm just looking at the numbers here very briefly, but I'm pretty sure the strong AD portfolio, these numbers are reversed, and we'll get that corrected. But that plus 23% is this quarter, and 47% is the since inception. So those numbers just need to be reversed. But otherwise, the numbers here I think speak for themselves based on our outperformance. So check that out. We'd love to have you join. You can do so at our homepage just by clicking on that Join Today button. The other thing I want to mention, if you do join, or those who are on trial or monthly members, or even our annual members, this webinar special really is unlike any other because we are starting our new ETF service. We're going to have it, if you're a member of our service, at any point between now and the end of the year, you're going to get the ETF service, no additional charge. We're just rolling it out. We're going to be, modifying it probably throughout the balance of the year. So we're not charging anyone for it. It's just part of our service. But come January 1st, we're going to break the services out because we have a lot of members who either want the ETF service or don't. They either like individual stocks or they like ETFs. Maybe, I have a feeling many of you are probably going to want both, and we will have a bundle. But for now, the special that we're running is if you sign up for an annual membership, or if you extend your current membership for 12 months, you can do so at our regular $697 rate. But a couple of bonuses here. Number one, you're going to get a bonus month. So you're going to get 13 months instead of 12. And then the biggie is that you're going to get our ETF service as long as you've extended out. So the example I gave, I think in the daily market report to members yesterday and today was, let's say you're an annual member and your account expires come February. If you decide to take us up on this, well, first of all, if you decide not to take us up on this offer, you will get everything, including the ETF service, no additional charge through your February expiration date. If you decide to take us up on this offer, though, and extend for the $697, you'll get 13 months from your February expiration date, and you don't pay anything for the ETF service until March of 2022. So this $697 is including the ETF service. John and I have talked about it. The pricing of the ETF service on an annual basis is probably going to be $497. So right there alone, you're going to be looking at a minimum of a $500 savings. But if you go through and actually calculate what the monthly membership will cost for both services and go out 13 months, you're looking at $2,200. And I think when you look at that and compare that to $697, I think you can see the deal that we're offering here. So this is a pretty good deal. If you like our service, really, you should be thinking about taking us up on this offer. All right, let's jump in. I said we don't need an agenda tonight. Literally, we are going to be looking at all kinds of charts. And what I've done, As John mentioned, our big earnings webinar is going to be next Tuesday. So in 6 days, that's when we're going to be looking out over the entire earnings season and pointing out, I can't possibly go through all the charts, but I'm going to be going through some of my favorites, some of the ones I would personally be avoiding as we get closer to those earnings dates. So I think it'll be a great event. That will be a members only event. This one's open to the public tonight. It's a sneak preview. But if you want to be part of that, make sure, if you're not already a member, just make sure you're in as a trial member. If you're a trial member, you're good to go with all of our webinars. So think about that. As far as tonight, what we're going to do, you'll see that I've numbered all these charts, and I'm going to pull this up on an edit so you can see how many charts we're going to go over tonight. 102 charts is on this list. That's how many we're going to go through. I'm going to go through them pretty quick once we get into them. But just to show you how I have this laid out, these first 6 right here are companies that reported prior to this week, but in October, and are on our strong earnings chart list. So all 6 of these, I found good enough reason to put them on our strong earnings chart list. First thing they had to do was beat Wall Street estimates as to both revenues and earnings. You can't get on our strong earnings chart list unless you do both of those things. Then you've got to be liquid. And then technically there's got to be something on the chart I like. Either the stock's performing well, maybe it's, just broken out above a key resistance area. Maybe it's just in a strong group. It might be underperforming its group, but because the group's so strong and this company beat, I want to keep an eye on it. So for whatever reason, there's something technical that makes me want to put that on our strong earnings chart list. So that's the first 6. Then you'll see I go to chart 101. That was Tuesday's pre-market earnings. If there were any after the market closed, they would have started with 151. But you can see there are none. We go from 101 to 109, so they were all pre-market. Then on Wednesday, whoops, it's not what I want to do. I don't know why it won't let me highlight that. But anyway, 201 right here on Wednesday, that is those are companies that came out this morning before the market opened. So from 201 to 209. Companies that were reporting after the bell tonight are labeled here 251, 254. We might take a minute to stop and look at those when we get to them, see what the after hours action is what's going on there. And then tomorrow morning, 301 to 308. Tomorrow afternoon, 351 and 352. And then Friday morning, 401 to 409. And then we go to Monday. There's nothing on Friday after the market closes. Then we go to Monday, which is 501 and 502. You can see the afternoons start getting a little bit more, a little busier next week. 551 to 560 is Monday afternoon. Next Tuesday, now I didn't get all the numbering done, but Tuesday afternoon, starting with Netflix, 651, all the way down to 672. And then these that I didn't get to finish putting numbers on, those are going to be Tuesday mornings. And then Tuesday after the close is when we're going to do our earnings webinar. I believe every company that reports between now and Tuesday that has a market cap of over $1 billion is on this list. So that's what we're going to go through the charts and look at. Where I do have them numbered, like for instance, Netflix, which is next Tuesday after the bell, 651 down to 672. Those are all after the bell and they're all in market cap order. So Netflix is the highest market cap stock that'll be reporting after the bell on Tuesday. Texas Instruments is next, Canadian National Rail, and so forth. And that's how I went through and numbered all of these, just so that you have some idea. As we're going through them, just to give you some reference, some point of reference in terms of their size, when they're reporting, and then we're going to look at the charts. So we got a lot to do here. 101 charts, actually 102 charts, and we'll see how fast I can get through these. So these first 6 I go through are companies that have already reported and are on the strong earnings chart list. Anything after these first 6 have not been added to the strong earnings chart list because I haven't updated it yet since this past weekend. All right, so let's get this party started. What I'm going to do, and hopefully as you go through, one thing I need to do already I can see is I need to bring this up on a relative chart. And this is a pretty cool feature, by the way, at stock charts, if you don't know how to do this. You can apply the current chart style to all the charts in this chart list. So I was, when I looked at this, it just came up with my default, which is price action, a PPO, and the accumulation distribution on the bottom with volume, moving averages, and so forth. I want my relative chart to show up. So now here's the relative chart, and I can apply this rather than change every individual chart when I get to it. I can just say, let's apply this chart style to all the charts in the current chart list. And hit the OK. And now as I go through, if I go to the next one, now you can see I've got my relative strength chart set up. So just a little tip over at Stock Charts, how you can do that with your charts. Okay, now they used to, when you would do that, you'd lose annotations. I don't think the annotations are lost any longer. But what I might suggest doing is maybe setting up a duplicate chart list before you make that change, just in case you've annotated. If you've got annotations on your charts, I don't want you to lose all the annotations on your chart. So just make sure you do a duplicate chart list before you try that. But I do think that Stock Charts made a change. I think that they've updated that now. All right, so first one here, Pepsi. Pepsi beat top line, beat bottom line. Look at the AD line. AD line strong. Look at price action now. Price action trying to make this breakout above the February high. Right there. We got to see a close above about 144 or 145. Relative strength versus soft drinks, just kind of so-so. Soft drinks haven't been a great area of the market, but I like the fact that we're seeing a strong AD line. I think eventually we're going to get the breakout here on Pepsi, so I wanted to keep track of it. I wanted it on my strong earnings chart list. Is this likely next quarter to be one of our portfolio stocks? Probably a zero chance of that. I want, when you look at the charts that are on the portfolios that we have, you won't be questioning whether or not there's solid relative strength. When you look at the company relative to its peers, you're going to see a line going straight up. Probably for many months, but certainly for the last 3 months at least. And relative to the S&P, same thing. And many cases, you're going to see that their industry group is also rising versus the S&P 500. That's really nirvana. That's what I look for in charts. All right, so anyway, that's PepsiCo. Let's move on. Constellation Brands, STZ, AD line looking pretty solid, moving up. Price action, similar to Pepsi. We haven't gotten up over 200 yet to test that February high, so we got a little work to do. But the distillers and vintners moving up, you can see on the chart here. On a relative strength basis, I view Constellation Brands, after making this move to the upside here and showing relative strength, I think we're just sideways consolidating. So I don't think there's anything horrible on the chart. And when you sideways consolidate, by the way, you tend to lose relative strength, especially in an uptrending market. So that's why you're seeing a weakness in relative strength. Like Pepsi, this is not going to be on any of our portfolios, but if it hits key price support, it certainly could be a trade from time to time. Levi Strauss, LEVI. Now this one you can see the AD line is weak, but price action's been very strong. Went right up to the previous high, couldn't get through. I think we're in a bull flag here. Nice move up, sideways action, rising 20-day moving average, I think would be a great entry. We're starting to see strength in clothing and accessories. And by the way, we're at about a 7-month relative high on clothing and accessories relative to the S&P 500. Levi is starting to turn higher about the last 6 weeks, beginning to show relative strength. But I really like that move here with earnings. Heavy volume move up. If we hold the 20-day and can break through 17, I think that would be very, very bullish for the stock. Paychex, PAYX, AD line strong. Price action breaking above the June high. Software strong. Is this one of the best stocks? No. But it is starting to strengthen relative to the S&P. It's in a good area. Next up, Lamb Weston, LW. AD line's been drifting a little bit lower, but we are trying to move up, trying to break above that June high at about 75. Volume definitely picked up with its earnings report. It is in an area where we are seeing 52-week highs. That's good. On a relative basis, not the best, but again, volume trends pretty good. Trying to break through a major area of resistance. I think this one's worthy of at least being on the strong earnings chart list. RPM International, AD line still holding those prior lows. I'd like to see that start to turn back up. Price action strong though. We are breaking out. Relatively speaking, it's not been bad relative to its peers, relative to the S&P near 52-week high. So it's good. Again, is it a portfolio, level stock? No, this is not one I'll be considering for the portfolios, but it is a stock that's beaten earnings and I think looks pretty good. And for anyone who's new to earnings beats, I prefer trading companies that beat Wall Street estimates because, number one, and primarily, they are, following through on their promises. When you beat your estimates, you're under promising and over delivering, which is what I want when I go to trade. I think that it cuts down on the likelihood or the possibility of a warning in the next quarter. I'm not saying it guarantees we won't get one, but I think it cuts down on the possibility. I think companies that have, that go through quarters and can beat Wall Street estimates and they show some relative strength and so forth, I have more confidence in trading those kinds of companies. That's why we go through and we do this research. All right, let's move on to what happened this week. So those last 6 I just looked at happened earlier in October. These are also companies that have reported. And just about every company that I've looked at so far in October has beaten bottom line estimates. Not everyone's beaten top line, but most all of these companies have beaten bottom line. And if earnings keep coming in ahead of expectations, I can't imagine the stock market's going lower. Not unless we start seeing a lot of warnings about next quarter, which I haven't really seen a whole lot of that either. So I'm thinking the market's going to really like earnings season, and we're going to continue to go higher. Now, Johnson & Johnson got right up to this high at 155, right there, backed off. AD line still okay. Pharma's trying to get through, haven't been able to break out yet. J&J just kind of going along for the ride. This one will if it beat revenues, and I don't know because I haven't looked at all these companies to see if they beat revenues. If this one beat revenues, it'll probably be on the strong earnings chart list. If it didn't, obviously it won't. JP Morgan, AD line's just horrible, and it is like this on a lot of banks. From a relative perspective, we're seeing JP Morgan performing pretty well relative to the banks. However, even though it's a leader in banks, look what it's doing relative to the S&P 500. Just because it's a leader in its group doesn't mean that it's a leader versus the S&P 500. JP Morgan's near 52-week low. I want no parts of this stock. I want no parts of most banks simply because it's one of the worst groups relative to the S&P right now. I think we got to get past this virus. I think some of these companies that are threatening the possibility of not being able to make make payments on their loans, I think that's what's holding back a lot of the banks right now. I think some of it is net interest margin, but I think a bigger part of it is just the uncertainty as to how big their loan loss reserve needs to be. Next up, Citigroup. Citigroup, look at the AD line, horrible. Look at price action coming back down from the 20. Last 3 months, we've been moving lower relative to the banking group. And obviously, we've already talked about the banks. I just don't see it here. Wouldn't have been in it heading into earnings, wouldn't have bought it after earnings. I don't care if they do beat. Part of the equation here in terms of trading is we want our stocks to beat earnings estimates and revenue estimates. But if Wall Street still isn't favoring these companies, why should we? Wall Street's got a lot of high-powered, MBAs. They've got huge departments, research departments. They're buying for themselves and for their clients. If they're not favoring these companies, stay away from them. BlackRock, earlier this week when I talked about it, I liked BlackRock going into their earnings. Why? Not because they've been such, they're part of such a hot group. You can see the asset managers group was at a 52-week relative low to the S&P back in September. But look at BlackRock. It's now at a 52-week high relative to the S&P 500, even though it's in a horrible group. So that clearly tells us it's one of the leaders. It's at a 52-week relative high to the asset managers group. It's broken out to new highs. It broke out above the September high, which was ahead of the February high. AD line is still fairly close to its high. I mean, this is one that I like. And if they beat their revenues, this definitely would be on the strong earnings chart list. And if the asset managers group started to strengthen, it is definitely one I would consider for portfolios. I just don't know if I'll be including financials. Financials will have a lot of work to do between now and November 19th, which is the date when we announce our next portfolio stocks. Financials and asset managers have to do a lot of work between now and then to warrant inclusion on portfolios. But BlackRock is one of the leaders there. With WIT, YPro, AD lines falling apart. Price keeps going up though. You know, and I've had members ask me about this, you know, would you not, you know, should you short a company that's going up with an AD line going down? I wouldn't short anything right now in a secular bull market. I believe we're going higher for a long time. I think the money is going to be easily made on the long side, not the short side. Why do I want to try and pick out, you know, out of 5 stocks, 4 of them probably go higher, in my opinion, over the next several months? Why do I want to try to find the one that's not going to out of each 5? I just think it's a waste of time. Why not stick with the trend? So when I look at this and I see AD lines going down, yeah, I mean, on a, you know, if you look at 2 companies and they both look identical on their charts, the only difference is their AD line. One's going up, one's going down. Then I'm going to favor the ones going up. But AD lines are secondary indicators. I never buy a stock just because the AD line's strong. You still have to have relative strength. You still have to have, you know, nice volume trends. You still have to, you know, be in uptrends. You still have to, you know, watch your moving averages that should be rising. The 20 should be above the 50. All these things should be taking place, you know, and add to whether a stock looks bullish or bearish. It's not just the AD line. AD line's been a wonderful indicator for us this year. It is not a primary indicator though. YPro, you can see relatively speaking, it's not in a great group, but look at the action here on a relative basis. Relative to its peers, relative to the S&P 500, solid. Price action moving up, heavy volume. I'm fine with the stock, even with the AD line weak. I'd feel better if the AD line was strong, but what I look at, my primary indicators are very bullish on this stock. Now, if it fell apart, it started losing key support, then I think the fact that the AD line's weak tells me I better keep my stop in play. Fastenal. I think overall this one looks pretty good. AD line's been rising throughout most of the past year. The group's broken out. We are starting to see a little bit of relative weakness. Maybe want to watch this relative low all the way back here in April. We're getting close to it. I'd like to see that hold. I don't want to see the stock really starting to break down and move to, you know, 8-9 month relative low versus its peers. It is moving a little bit lower versus the S&P, but like I said, I'd like to see this begin to move up. Now, when I see that and I see the stock and I think, okay, I kind of like it, but this is starting to weaken, then I pick a spot and I make sure I stick to it in terms of a stop. I think these recent lows, we should not close below $43 on this stock. If we close below 43, I'd be out, just based on everything else I'm looking at on the chart. EDU. AD line's moving up, price action's moving up, relative strength pretty strong across the board. Relative to its peers, it's just kind of, you know, so-so, but everything else is pointing higher. Overall, I think this is a pretty nice looking chart. FRC. Well, I talked about banks and how very few of them look good on their charts. Well, this is one exception. FRC just broke to a 52-week high yesterday, did back off of it, had a reversal. But look at the relative strength here. Easy 52-week relative high versus the banks. Relative to the S&P, it's mostly just sideways. We go through periods up and down. But if you look back, I mean, we're right where we were versus the S&P at the start of the pandemic. So it's not been a great outperformer of the S&P, but it is clearly one of the best banks. AZZ, this was the last one from Tuesday. AD line, not so great. Still haven't been able to break above that June high. The group's been pretty strong. You know, it's moving up. Relatively speaking, it just hit about a 9-month high. But AZZ is down near a 52-week low versus its peers and versus the S&P 500. I think we have to be really careful with AZZ. I'm not a fan of this one. Next up, let's move on to Wednesday. So this morning, UNH, and I talked about this a little bit in our daily market report today. Look back at the healthcare providers group and look at where we're sitting, just above 2,300. The high in February was also 2,300. Actually, hold on. Okay, sorry about that. UNH, you can see here, the relative strength is very strong. So this is one of the leaders in the space. So if ever we're going to get news, a catalyst to drive the healthcare provider area higher, I would have thought maybe UNH would have done it. But it didn't. We did not get that big pop with earnings today. The numbers were pretty good on UNH. We actually beat bottom line. I'm not sure about top line, but we came in very strong on the bottom line, but it wasn't enough. We gapped down. I think the chart here still looks good, by the way. Above the 20-day, relative strength is good. If you see healthcare providers breaking out, I think UNH is a great way to play it. But we haven't gotten that breakout yet, so I think we have to be a little careful here. BAC, which is Bank of America. This one I don't like at all. You can see on a relative basis, it was actually holding up pretty well until about 3 or 4 weeks ago, started to roll over, but they missed. This is one of the few companies so far in earnings season where they missed. I think their number was like 51 cents versus 53 cents, if my memory serves me correct. But we still got a lot of work to do here on the Bank of America chart. And once again, bank index is horrible relative to the S&P. So I just, when you look at Bank of America, it was down near a 52-week low relative to the S&P, even though it was one of the top performers in banking. So I just think you got to avoid Bank of America, just like you have to avoid most banks, if not all. ASML, this is in the semiconductor space. I like this one. Even though they had a kind of a muted response to their earnings today, I think you got to break out. Maybe we pull back to test that rising 20-day. AD line strong, semi strong. I think what we've been doing, we've been underperforming for the last 3 months on ASML, but look at what we've been doing. We had a high established in July, and we've been consolidating. Now that we're breaking out, and again, if we pull back, hold that 20-day and move to a new high, I believe you're going to start to see this relative strength pick back up again. So I'm a fan. I actually like ASML. Wells Fargo, another bank. This one's been underwater. It's just not a, look at where we are relative to the June high. Look at where we are relative to the May low. We're not far from the pandemic low on Wells Fargo. The S&P 500's gone from 2191 to 36, almost 3,600. And Wells Fargo is up $1. I mean, it's awful. And so it's one of the worst stocks. Look at the relative strength versus banks. One of the worst stocks in one of the worst areas of the market. And I was with a friend the other day, and they're like, I've really been, picking up some of this Wells Fargo. It's really beaten down. And so, of course, I had my earnings beats discussion with him and said, yeah, that's a stock I wouldn't touch until the group begins to show strength and this stock begins to show relative strength. The last thing in the world I want to own is a stock that is one of the weakest in its peer group, and its peer group is one of the weakest in the stock market. I mean, that's a good way to lose money in the stock market. No, thank you. And I mentioned, I think earlier, I bank with Wells Fargo. So my money goes in there for deposits, but it ain't going in the stock. Goldman Sachs, huge earnings report today. AD lines down near 52-week low, can't get a breakout. Even today with that huge report, and the earnings came in at 9 something. The market was expecting, I think, 5 and change. Stock was up 42 cents. Relative strength versus its peers, not very good, mostly sideways. And then its peers, investment services relative to the S&P, just horrible. Stay away. INFY, pretty good action here. AD line breaking to about a 6-7 month relative, or 6-7 month high. Price action's been strong, probably a little bit overbought in the near term, but look at the relative strength. This is what you want to see. The group, not so much. We do have a double bottom in play here, so maybe if we can get back up and break out above this high at the end of July on a relative basis, that would be good. But it is a leader in its space. It's a leader by a wide margin in its space, and that's enabling it to easily outperform the S&P 500. Volume trends are strong. I don't want to chase it, but a pullback to the rising 20-day would be pretty solid there. USB, another bank. You can see AD line drifting lower. Okay, relative strength is strong, but not really seeing anything in terms of volume trends. And it's just weak group. I'm just really not overly excited about anything in the banking space. However, I am somewhat excited about Progressive. I like Progressive. I love the AD line moving up to confirm the price action moving up. I really like Progressive relative to its peers, up at a 52-week high. It's outperforming the S&P, even though its peers are underperforming the S&P. So Progressive, if I was going to be in insurance, Progressive would be one of the stocks I'd be considering. PNC, another bank. You know, this one over time has been a pretty good bank, and you can see there's your 52-week relative high to the banks at the beginning of October. But we can't get a breakout. Still got this gap resistance right here. It's holding us back at about 117. And, you know, bank's horrible on a relative basis. Moving on. Okay, after hours tonight, I have not looked at these. I have not looked at anything after hours just yet. So we're going to look at it together here in a minute. I am not a fan of the airlines. I think, you know, maybe with options expiring, perhaps we'll get a little bit of a lift because there are probably a lot of net in the money put premium out there on many of these airlines. So maybe in the short term, we'll get a little bit of a pop, but I wouldn't be expecting a whole lot beyond that. You can see on a relative basis, airlines versus the S&P just been horrible. And you look at it and you say, well, you know, this doesn't look like it's that bad, but this isn't really scaled. You have to look at where it was, 0.09, and now it's under 0.045. That's more than 50 percentage points underperformance. That's massive underperformance by the airlines. And then you look at UAL relative to its peers, and it's going down. Stay the heck away. At some point, there will be a time when airlines are back in favor. Maybe there will be a point. I don't know for sure, but probably. That's when I want to own them. I want to own them when Wall Street is rotating and money is rotating toward that group, and that group is trending higher on a relative basis. This is not trending higher on a relative basis. Stay away. Now, having said that, probably up after hours, but let's take a look. UAL, down 1%. No big shakes there. All right, let's take a look at the next one that reported after the bell today. Alcoa. I can tell you looking at this, I'm not a huge fan here. Accumulation distribution, pretty weak. We do still have higher highs and higher lows in play. This is in the aluminum area. And you can see Alcoa just kind of going along for the ride with the aluminum index. On a relative basis, though, downtrending versus the S&P. I mean, I don't see anything to be excited about here as AA reports. Let's see what they're doing after hours. Stock down 4% after hours. Next up, ACCD, Accolade. This is a fairly new stock that just came out, went public in early July. It's in the software space. Now we got a little different animal. Stock is breaking out to new highs, post-IPO highs. Software getting close to its all-time high again. And ACCD relative to the S&P 500 and relative to software breaking 52-week highs. Now, there's not a lot of history in this stock, but I do like what's happening on the chart. Is that translating into a good report or at least a positive reaction? No, it is not. ACCD is down 7.5%. Now, I don't know if this company beat, and in fact, I am going to pull up on my other computer right now. I'm going to see if they beat their bottom line. Because a lot of times companies will beat, and then they just, you know, it's built in already. And this company's had a big run. I am showing that they came in with earnings they had a loss of 40 cents. Market was expecting a loss of 41 cents. So, or no, I'm backwards. They missed. They had a loss of 41 cents and the market was expecting a loss of 40 cents. So they actually did miss. Most companies I'm looking at today beat, but this is one that missed. UAL, by the way, missed by 53 cents. They had a loss of $8.16. Market was expecting a loss $7.63. But let's keep moving. Next up is, and I think this is the last one, Sleep Number. Sleep Number right up here at 60. This is going to be a big day for this company in terms of its earnings. Can we get above that $60 level? Furnishings, you can see, been rising, but still well off the earlier high. So this has not been a great area. Sleep Number relative to furnishings, though, has been pretty strong. Relative to the S&P has been pretty strong. Furnishings relative to the S&P, trying to move back up to about a 7-month high, 6-7-month high, but it is still off of the high from about a year ago. So having said all that, I probably would not have taken a chance on this one, but I think it is big today to see whether or not we're going to get this breakout on Sleep Number. And we are 8.5% after hours. So stock up almost $5. That will, on the chart, take it well above this resistance at 60. So it looks like we're going to open up above the resistance area. All right, moving on to tomorrow's earnings. So these are before the bell tomorrow morning. So I'm giving you my thoughts ahead of time. I like the semiconductors. And when you look, Taiwan Semiconductor, TSM, has been trending higher relative to the group. The group is exploding relative to the S&P 500. I will be shocked if Taiwan Semiconductor lays an egg in the morning. I think the company's going to have a big report. Now, does that mean it goes up? I don't know. That's always the tough part. I think we're going to have a good report. I think whether or not it's a good entry now, I don't know, but I do think it could set up for a good entry at some point. Based on just what I'm seeing on the chart, I like the company. If they beat top and bottom line, they will absolutely be on our strong earnings chart list. And it's even possible that a company like this could get onto our portfolio, one of our portfolios. I mean, semiconductors looking like this, I'm going to want to have a semiconductor stock in each of the 4 portfolios. It's a really nice looking relative strength move on semiconductors. That tells us Wall Street's pouring money into the group. So yeah, I'm going to be looking for 4 different semiconductors that meet our criteria, leading stock in a leading industry. And those 4 will very likely find their way onto our 4 portfolios. Usually there's a couple of industry groups, maybe 2 or 3, that are so strong that I want to have representation in all of our portfolios. Anyway, TSM looks really good to me. Morgan Stanley, AD line dropping. You know, we were starting to show some strength back over the summer, and now we've kind of fallen back apart. Relative strength has dropped. And once again, poor group, investment services. So Morgan Stanley's right there with Goldman Sachs. I'm just not a fan. I mean, if they come out with great numbers, let's see what kind of reaction we get. But I want to see some relative strength, and we're just not seeing it. BB&T. This is ticker symbol TFC. A bank. Yeah, it's a leader relative to the bank index. That's wonderful. But it's still not able to get through its June high. They're just, you know, on a relative basis to the S&P, I want to see outperformance, significant outperformance. And we're getting a little bit of that here over the last few weeks, but I'd be concerned. I'm not a fan. Walgreens. I mean, could a chart look any worse than this? Honestly, the AD line breaking to multi-month lows, getting close to a 52-week low. WBA, Walgreens, downtrending in a secular bull market. It's downtrending. It's been downtrending since March, before March, and after March. No chance I'm interested. Look at all the panels here below. Everything's pointing lower. This is exact opposite of what I want to see. This is for the value investors out there. If you're a value investor and you think this is a great deal, be my guest. I want to see relative strength, and we're not getting it yet. WNS, AD line, kind of flat here. Price action's going up. Chart doesn't look terrible. I mean, overall, business support services has been pretty strong. Relative to the S&P, we've seen a little bit of a pullback, but overall, we were, in the last few months, we've been at or near 52-week relative high. So this has been a pretty good group. The stock is okay relative to its peers and relative to the S&P. So I'm going to just say this is okay, maybe a little better than average. Would I buy it going into earnings? No. HOMB, home bank shares, AD line falling. Just going to scroll right through these banks. I think everybody's gotten the picture there. Commercial metals, AD line, 52-week low. Price action, though, near a 52-week high. Interesting. Steel moving up. CMC relative to steel, for the most part, trending higher. I think everything looks pretty good, except I'd like to see steel break out relative to the S&P. We've had multiple reaction highs on a relative basis at about 0.62. Let's get that breakout. Then maybe we'll start looking at leaders within the group, which CMC is one of. This one I think will be interesting for, in terms of earnings tomorrow morning, but it needs a solid report as a catalyst to maybe help get that breakout on a relative basis. APHA, this one relative to the S&P, it doesn't have all the industry information. But what I can tell you is that we did have volume come in on October 12th to forge to a new high. We're pulling back, but I think anything to test that 20-day moving average, I think would be a very, very good entry. Sometimes, I noticed, and this is one difference probably in my trading now versus probably 8-10 years ago, is that I used to look at breakouts, and if I went back and closed below the breakout level, I would exit. Now, a lot of times what I'll do is when I get a breakout, I'll maybe enter half of position. And if it goes back below the breakout level, I don't exit. Instead, if it keeps going down and I get a 20-day test, I usually will take my other half of my position. Just because sometimes you get the breakout and stocks just keep going. But many times I've noticed you get that breakout, gets a lot of folks jumping in. And then when it goes back to 5.25 and you're down $1 on it, everybody who got in at the top, being down 18% in 2 weeks or a week, they panic and they get out. And then you hold the 20 and then you start coming right back up again. So I think APH looks good, APHA, but I would say you got to wait maybe a little bit for that pullback. And again, with earnings coming up, maybe we'll have a good report, but buy on rumor, sell on news. Maybe we'll get a sell-off down to that 20-day. All right, tomorrow afternoon, ISRG, Intuitive Surgical. Nice uptrend, nice AD line. Medical equipment breaking out. Relatively, ISRG doing very well against its peers. And I'd say medical equipment stocks are holding their own against the S&P 500. Overall, I like this chart. I wouldn't be surprised to see a good report coming out from ISRG. Martin Transport, AD line weakening. It is in that trucking area. Truckers have been consolidating. While truckers have been consolidating, we've seen Martin pull back. I just don't like Martin relative to the truckers. I think the truckers are actually pretty strong. I would be looking at something else within this trucking space. C.H. Robinson, CHRW, would be my choice in trucking. I like the chart on that one. And I think it's also in our income portfolio. All right, then we go into Friday morning. Bank of New York Mellon. Again, I don't want to spend much time on the banks. Well, they've got it classified as asset manager, I guess a little bit of both. But still, overall, trending lower. Look at the relative strength versus its peers. 52-week low. No, thank you. VFC, trending lower here, AD line. Price action trending higher. Looking at the relative strength, we're seeing a little life the last 6-7 weeks. And this is what I mentioned earlier, clothing and accessories starting to show a little bit of strength. This stock's beginning to show some relative strength. I think this is going to be an interesting earnings report. Market is maybe starting to anticipate better fundamental information. And so I think this is going to be a big test for the company on Friday morning as far as its earnings go. State Street, we got another one in the financial space, asset manager. Stock relative to its peers, not very good. I'm going to pass. Schlumberger, just about anything in the oil patch, I'm going to avoid. Energy, just not very strong. I would make one exception. That would be renewable energy. But I think even worse than banks is the energy group as a whole. Look at the AD line. Lots of folks, in my opinion, have been selling Schlumberger. We're nowhere near that June high where we got up to 23.5. We're back down to less than 16 now. Not too far from the March lows. There's just no money rotating into this group. Stay away until you see that relative strength return. Kansas City Southern, I look for a big report. When I look at it, I know relative strength has been declining here over the past 2.5 months, or maybe 2 months, but it's all been during this consolidation. We have been consolidating. I actually look at this as a move up, sideways. This is almost a flagpole with a flag. I think we're going to break out with earnings. I think Kansas City Southern is going to have a big report. I'll be surprised if they don't. And I would be looking for a move through 200. JB Hunt, talking about truckers. Now this one is, when you look at it on a relative basis, kind of like Martin's, not one of your best. C.H. Robinson's not reporting, but let me just show you this chart since I've now mentioned 2 truckers. Look at the relative strength here versus trucking. See the relative strength line going up. So you got truckers trying to break out. You got CHRW, which is now, just hit an 11-month relative high versus its trucking peers. 52-week high versus the S&P 500. Truckers solid against the S&P. That's why this stock is in our income portfolio. It's a leader within that space. All right, CFG, Citizens Financial, talking another bank. AD line, horrible. I mean, yes, it's a strong performer relative to the group, but the group's awful. Ally Financial. This one kind of like that FRC that I talked about earlier. If I was going to look at any banks, it would probably be FRC or maybe Ally. Huge advance here on the stock off of that low. It's now almost tripled from its March low. So it has outperformed the banks by a mile. And it actually is sitting at about a 7-month relative high to the S&P, even though it's in the bank group, which has been horrible. So this is one that I think is continuing to perform pretty well. If I'm going to own a bank, I want a bank that can outperform the S&P. Ally's been doing that. So let's see what happens in this earnings report. Here you got a leader. So, JP Morgan certainly hadn't been doing nearly as well as Ally, but it's been outperforming the bank group. And the market wasn't impressed when they came out with their earnings. Didn't get a breakout. So let's see what happens with Ally. And we'll know more about that on Friday. Badger Meter. This one, AD line starting to tick higher. We did make a breakout, 52-week high. That's good. The group is at a 52-week high, or very, right up against that. And the stock is starting to show some relative strength, sitting at about a 5 or 6 month relative high versus its peers. It's now at about a 3-4 month relative high versus the S&P 500. It's okay. It's not, again, I'm not jumping up and down over it, but it's an okay looking chart as we head into earnings. Next week, starting on Monday morning, Halliburton. Stay away from it. Stay away from the energy. Moving lower. And I got an email the other day and they're saying, why do you keep talking so badly about energy? Some of these energy companies have really nice dividends. And I'm thinking, okay, so I can underperform the market by 30% and I can get a 5% dividend. I'm not interested. And honestly, as a short-term trader, I'm not really a dividend. I don't look for dividends. Now, if you're a dividend person, you're looking for income as opposed to capital appreciation, I'd be looking at our income portfolio. Those are companies that pay a decent dividend. They're not going to be 5%, but many of them are 1 or 2 or maybe a little bit over 2%, way more than you're going to get in your bank account. And they're also leaders. So you might get a little capital appreciation to go with it. Anyway, looking at Halliburton, look at these numbers. Yeah, it's leading in its industry group, but is it leading the S&P 500? No, it's been downtrending since June. Just not a fan. Lennox, AD line breaking to new highs. We also broke all the way back in July. We took out this double top to set a new high in 2020. The group is pretty strong. This company is just kind of doing okay relative to its peers, but its peers have been strong. This is a really strong group. So just being okay relative to your peers when your peers are on fire isn't a bad thing. Relative to the S&P, it's coming off that low in April. I think it still looks fine. Probably not my favorite stock in the group, but It's okay. This one I think looks pretty good. I wouldn't be surprised to see a good report. IBM, when it gapped up the other day, first of all, look at the failure. See that tail up above this prior high and then the failure? Look at the relative weakness on IBM. When you get a stock that has been downtrending relative to its peers and relative to the S&P 500 for 9 months, and you see a false breakout like that, just get out. Take your money and run. Could it break out? Sure. And you can always get back in if it starts to show leadership. But that to me was a warning sign. IBM's been going down ever since. The best scenario here is that it holds its moving averages and gap support, turns back around and goes back up and closes above 135. I wouldn't hold my breath. CDNS, I expect a big report here. We are now talking about one of the best stocks in software. You can see longer term CDNS relative to the software index is higher. Yes, it pulled back here, but remember, we've been consolidating. We're just back up near the high. The stock's starting to lead again. I think it's going to go higher. This is one that has been on our portfolios before, and it might find its way back on again next quarter. We'll have to see how the earnings report comes out, how the market reacts. Does it outperform for the next several weeks? But CDNS looks good to me. I think we'll see a good report here. PPG Industries, accumulation distribution looks pretty good. Price action, pretty decent. Volume trends, not bad. Nice little move recently. Relative to its peers looks good. Relative to the S&P looks good. Its peers are just not great. That's the biggest problem. And it's in materials. Many of the areas have come off their lows from March, April, as we've seen some strength with the dollar declining. But overall, this is not one of my favorite areas. I do like the stock within the area, but I think there are a lot of other stocks that deserve attention over and above PPG. I think the numbers could be pretty strong on the earnings report, but I just want to see the overall group and their industry group begin to show a little bit more strength on a relative basis. Logitech, AD line strong, price action. Look at this price action. This one looks real good, really good to me. I mean, all the way back in, and this was, when I talked about AD lines and how important they have been in 2020, look at this chart. Look at it. Here's the moves lower here, moves down. See the AD line drop? And then we come tumbling below that prior low and the AD line goes up. Why? Because there are no filled candles. There's no selling during the day in March. All the selling came at the open. And then we were seeing buying, hollow candles, or look at these long tails. That means off of the lows, we came rallying back during the day. That adds to accumulation distribution to the upside. So those were key signs. And this has just been this is a poster child right here. Stock was down in the low 30s. And since then now is all the way back up over $80. AD line continues to be strong. Relative strength looks great. I have nothing bad to say about this stock. I'll be shocked if they don't have a good report come Monday. ELS, Equity Lifestyle Properties. This is in the REIT area. AD line's pretty good. Price action, not so much. Double top, haven't been able to break through yet. It's one of the better. I think this is a retail REIT, I believe. I'm not sure. But anyway, this is, or maybe it's residential. But anyway, it's looking good relative to its peers. But look at it versus the S&P. If our goal is to outperform the S&P, this peer group is not the group to be in. Stay away from the stock. CCK. This one's okay. AD line looks pretty good. We did just recently break above February high, so we're now at a 52-week high. On a relative basis to its peers, looks pretty good, strengthening versus the S&P. And its peers have started to strengthen here over the last 6 weeks. Definitely an improving picture. If not a strong one, definitely an improving one. So I think Wall Street's expecting a better report here, and we'll see if we get it. Again, these are all companies reporting on Monday. STLD, Steel Dynamics, AD line looks good. Just recently broke out above the price highs, set back in August and September. AD line back here, I think I said was strong. But looking at the charts, we're getting some pretty good relative strength. The big problem is just the steel group. Steel has not been a great area of the market. Maybe we can get a breakout, and if we do, then we've got a leader. Until then, I think we got to be a little careful, maybe just a little bit on the cautious side here. Zion Bancorp, AD line horrible, price action horrible, relative strength horrible, and the group horrible. I don't really need to add anything more there. ADC, Agree Realty, another one in the real estate space, and this one holding this recent support area, but we've been going sideways now for 4 or 5 months, and so the relative strength kind of rolling over, not only versus its peers, but look at it relative to the S&P, down near 52-week low. Stay away. HXL, Hexel, AD line, for the most part, trending lower. Price action trending lower. I can tell you already there's nothing I'm going to like here. It's in the aerospace area. Look at aerospace relative to the S&P. You know, Boeing's been under a lot of pressure throughout 2020. I'm just not a fan of aerospace. Let's wait until these groups begin to start showing relative strength, and then we'll come back and revisit. I don't care about catching a stock at the bottom. I really don't. I want to catch momentum. I want my account to always be working for me with momentum. And I can't do that when I'm trying to catch bottoms, especially bottoms that seem to never form. They just keep going lower and lower. Netflix, this is coming up on Tuesday. So now we've moved to the final day. I'm not going beyond Tuesday because we got our earnings webinar, Q3 earnings webinars next Tuesday after the bell. So we'll be able to talk about some of these stocks. We'll see how many of these I got right, how many I got wrong. But Netflix, I think, is going to have a blowout quarter. I mean, a blowout. I think it is being heavily accumulated. On a relative strength basis, you might say, well, you know, it's just kind of doing so-so. It's consolidating, folks. After an uptrend, it's consolidating. I think it pulls back maybe one more time to the 20-day, but I believe we're going higher. I think with earnings, we break out. Texas Instruments in that semi space. They had a good earnings report last time, or maybe it was raised guidance. I think I may have seen. I'm trying to think when it was. No, I think it was back in here when they reported their earnings and went above 135. They've been trending higher ever since. Look at the AD line moving to new highs. Semi is going higher. Now, relative to the semis, would this one, is this going to be in my model portfolio? Not unless they come out with a massive report, because they're not one of the leaders in the semi area. But, you know, rising tide lifts all boats. In this case, a rising tide, a rising semiconductor tide lifts all semiconductor stocks, because relative to the S&P, Texas Instruments has been awesome. Broke out about 148 last time. I think a pullback anywhere near 148, maybe even down to that 20-day moving average, I think could be a good trade. But I will say, I think other semiconductors look better. Many other semiconductors look better. Canadian National Rail, I think we've got a pretty decent looking chart here, moving higher. AD line looks good. Railroads, as I mentioned, breaking out. Transports, railroads and truckers look awesome, in my opinion. Starting to see, we just saw railroads relative to the S&P set a new 52-week relative high in September. So if you're going to break, you know, if you're going to beat the S&P, railroads will help you do it. CNI relative to the S&P looks strong, and I think it's been trending higher now ever since that low that we saw all the way back in late May. So CNI, I think, looks pretty good. I'd expect a big report there. Snap, SNAP. Yeah, I think, again, AD line looks pretty good. Just recently broke out above those prior highs. On a relative basis to the internet group, I think this is one of the better looking stocks. So I like that. Do I like something like Pinterest better, PINS? Yes, I like Pinterest better. So I think there are internet stocks out there that look better, a lot better than Snap. But I like Snap. I think Snap could come out with a pretty nice report on Tuesday. IBKR. And by the way, these are all Tuesday afternoon. I'm kind of skipping out a turn. If you weren't here at the very beginning, I was numbering these in a certain way, and I just didn't get to the before the market open reports on Tuesday. We'll go over those last. So these are all right now. These are all Tuesday afternoon reports that will be coming out. Interactive Brokers, IBKR, in the investment services area. This one looks pretty good in terms of its AD line. In terms of relative strength, it's okay, but the group is not great. So I just see a mixed picture here. AGR, Avon Grid, AD line breaking out, price action trying to break out above this 56 level. Overall, I think it looks pretty good. This is a multi-utility, And you can see with this push to the upside here in the group, we're also getting relative strength. So that's what's leading to this huge move to the upside in AGR. On a longer term, though, basis relative to the S&P, its peer group, it's been a little challenged. So this is not a bad looking stock within this group. I would favor a decent report. I just don't know maybe if it's already been built in. Teradyne, AD line fell apart here, but semiconductors have broken out. Relative strength also has fallen apart. This is one of those where I would be really upset if my stock were, if Teradyne were to fall back below about 74, 75. Now, granted, we're at 86. I don't want to see it go back down that far, but I think when you're looking at the chart, higher high, higher low, higher high, higher low, I think that 74, 75 area is really important on this chart. WRB, this is WR Berkeley Corp, AD line down near 52-week low. Really need to get a breakout above about 65, 66. Haven't been able to do it just yet. Stock looks pretty good relative to its group, but the group doesn't look very good. So mixed bag here. Maybe earnings can carry it up through 66. That's what I would like to see. CSL, Carlyle Group, still well off of that June high. Hard to endorse a stock that's so far off of the June high when the S&P has been going up. Look at the relative strength. Just everything at or near its 52-week low. I'd have to pass. REXR. I actually like this stock here on the 20-day test if we get it. I mean, there's your price breakout right there above about 48.75. 20-day moving average, 48.47. So this pullback, I think from a trading perspective is kind of interesting. Stock 2 days ago was over 52. Now you can get it at 48.80. So I do like that. Look at the relative strength here. Huge move to the upside. Now this is in the REITs, so you got to be a little careful there. But this is a major leader in the REITs. So the REITs itself, its peer group down here 52-week low. That's the downside. And the reason why I'd keep a tight stop. If it closed below the 20-day, I wouldn't give it any excuses whatsoever. That's the difference to me between it being in a good group and being in a bad group. Being in a good group, I might be willing to give it a little bit more room. Being in a bad group, no questions asked. If I break down, I get out. PNFP, Pinnacle Financial Partners, downtrending stock, downtrending AD line. I don't even have to look anymore. No interest in this stock at all. Tenet Healthcare, THC, AD line looks pretty good. Still can't get through that $30 level, though. I want to get a breakout above 30. It's in the healthcare provider group like UNH. Maybe we'll have a big report from this company. Maybe that will be the catalyst to get healthcare providers moving higher. But right now, I would be really careful. The group still remains in the downtrend. Let's get that absolute breakout on healthcare providers. Let's get a relative strength move to the upside. And let's see THC get the breakout. Then we'd be talking. WDFC, this is WD-40 company. Clearly overhead resistance 205 to 210. I think you can see that on the chart. March high, July high, September high, all in that $5 range. So I think we got to get a close above 210 before I would be interested. Its group is moving higher, but on a relative basis, it is one of the worst performers within its group. So I'm not interested. If it breaks above 210 and starts to show relative strength, I'll revisit. Until then, I ignore it. iRobot, IRBT, AD line starting to turn back up again. Price action, we just got to close above 90. The group's been moving up. IRBT relative to the group starting to turn up a little bit. Group is strong. I got some mixed feelings here, but earnings could dictate here on this chart. We want to get another big pop to the upside. If I had to take a guess here, I would go with a strong earnings report. I just think the way it's trading, the way its group is trading, I think we could have a big report on iRobot. HWC, this is Hancock Whitney, AD line weak. Price action still nowhere near June's high. I'm not going any further. Navient, NAVI, same thing, at least on the AD line moving down. We did get a breakout above the $9 area, so we have started to show a little bit of strength. We are now at maybe about a 5.5 month high versus its peers. Versus the S&P, we're right near about a 6-month relative high. The group is okay. I don't know. I'm kind of middle of the road on this one. Fulton Financial, moving back into the banks. I mean, just 2 weeks ago, 3 weeks ago, we were at a 52-week low. Zero interest in this stock. Zero. If I could go lower than zero, I would. UCBI, United Community Banks, back in banks again. Still, relative strength. Not interested. Not interested at all. USNA, Health Sciences. AD line, still kind of in a downtrend longer term. Price action, we looked pretty good back in July. Since then, though, you can see we've kind of rolled back over again. I think we're consolidating between the low here, down around 68, 69. Also, you can see gap support coming in there. To the upside, right about 91, 92. That's the range for me. And we're sitting almost right in the middle of the range. I just don't know. I don't know what's going to go on with this stock. And looking at the relative strength panels, I'm not overly excited. I'd stay away. First, Midwest Bancorp. This stock, AD line, horrible. Price action, horrible. Not interested. Calix Networks. AD line looks good. And while maybe you might say, well, we've been downtrending the last 2 or 3 months, look at how far the stock has run from 5 and change to 22 and change. It's entitled to a little bit of consolidation. Since it's been consolidating, since it reached this top in August, the relative strength line's been coming down. I think that is misleading. I think this is a nice looking chart. I think we've resumed our uptrend, and a breakout above 23 would be very bullish on the stock. I think we're going to do it eventually, and it might be with earnings coming up. Hope Bancorp. AD line, 52-week low, price action, horrible. Relative strength, just awful. Stay away. Now we're going to go into these are the last charts I'm going to show you. But this is going into the Tuesday morning, pre-market charts. I didn't get them numbered in time. So all of these will be coming out, and they're not in order of market cap either like the others were. But let's go through and look at them anyway. ACI, downtrending AD line. I mean, we just put in another new low in September. I don't even need to look at anything more. I'm not interested. CBSH, Commerce Bank Shares. This used to be a leading bank, relatively speaking, all the way back in March. It was actually held up much better than the overall bank index. And you can see AD line actually broke out while prices were going down. But it really hasn't done much since then. It's kind of flat over the past several months. So I'm not interested. CIT Group, AD line moving down. We're still way below that prior June high. Relative strength panels are just awful. No interest. All right, what else do we have? CMA, Comerica, also in the banking space. Probably should just go right past all of these banks. I mean, this one's doing a little better than the bank index, but still not performing well versus the S&P. And that's the problem. Even if you're doing well versus your peers, it probably just means you're just not doing horrible. You're doing a little bit less than horrible. Canadian Pacific Railway. Now, this one, the AD line doesn't look as strong, but man, everything else looks pretty good to me on this one. So I would probably tend to ignore the AD line and focus in on everything else that looks good. Railroads moving up. The stock is near a 52-week high. Actually, it looks like today it set a new 52-week high relative to the railroads. So you've got a leader in a group that's leading. That is a good sign. I would expect a nice report out of CP. Dover Corp, AD line set a new high a little over a month ago, but it has been pulling back. The group, industrial machinery, moving up, but the stock relative to the group down near a 52-week low. So I'm thinking this one's sending mixed signals. I'm not interested. GATX, sideways consolidation, mostly on the AD line. Price action, trying to get through 70. We need to get a move through $70. I do like this bounce off the 20-day. Now, that could be a sign that we're trending higher and we're going to go right up and break out through 70. Maybe we need to see the earnings do it for us first. But I would not buy. I would not be buying the stock in anticipation of a breakout. Why? Because this thing has been horrible relative to its peers and relative to the S&P 500. So yeah, price action might be looking a little bit better in the near term. AD lines kind of so-so. Relative strength is horrible though. We want to get all these things lined up for us as best we can. GPK, graphic packaging, AD line's been awful. Still can't get above the June high. And that's considering that the group is broken out. So look at the relative weakness. Awful. Stay away. IQV. You know, when you look at a stock like this, by the way, GPK, why is this stock so badly performing relative to its peers? That's what you got to ask yourself. What does Wall Street know? They visit management teams. They have a pretty good idea. Now, management teams, they're human, and some of them don't like to tell the truth as much as others. And so sometimes you find out the hard way that they may be leading you in one direction when in fact the business is going in another. But when they do that, they tend to get ignored by Wall Street for a long time. It's not a really good idea to mislead Wall Street. You'd better just come out and spill the beans and say things aren't good, rather than say, oh, yeah, I think things are going to pan out pretty good. Then the end of the quarter and you come out with your report and you miss and you lower guidance. Wall Street has a long-term memory when it comes to that. All right, IQV. Looking at healthcare providers again. Now, when you look at this one, it's been uptrending for a while. Kind of like UNH, I think this is one that is strong. Could be the catalyst to get the breakout. Notice that 170 area multiple times. Many of these healthcare providers trying to make big breakouts. We need a catalyst. Maybe IQV will be one next week. We'll see. Iridium Communications, IRDM. Starting to see the AD line roll over. Price action was falling apart in September, but we did rally back pretty quickly. The overall group doing okay. Set a 52-week high at the beginning of September. Relatively just kind of so-so. I mean, I'm not overly impressed. Mixed numbers and so forth there. LMT, Lockheed Martin. First of all, when you go down here and look at defense, kind of like aerospace, I'm probably not going to like too much in this space. If I was going to like anything, I probably would like Lockheed Martin. Look at it on a relative basis versus defense stocks. Even though defense stocks keep going lower and lower, you know, we're actually trying to outperform the S&P 500 over the past few months, but there's just not enough here for me. I would pass on Lockheed Martin. Manpower Group, still can't take out the June high. AD lines weak, relatively speaking, versus business agency or business and employment agencies, business training and employment agencies down near 52-week low. The market or the group itself has been downtrending for 4 or 5 months. We're trying, I think I wrote about this one yesterday in the DMR, we're trying to get through this 138 area. Just haven't been able to do it yet. I think you're really just hoping if you jump into Manpower before earnings, I would avoid it. PCAR, PACCAR, AD line looks good. Really nice action back in June, July. I think we've been consolidating since then, and that's why the relative strength line has been going down. But it has gone down a lot. I mean, it's not just gone down a little bit. That's a lot of underperformance. The group has been really ripping to the upside, and we haven't been able to get a breakout in that environment. So unless we come up with a big earnings report and have a big breakout, and it's possible, but unless we do that, I think probably I'd look for other area or other stocks in this area. Procter & Gamble, AD line's been strengthening since we were down at that 52-week low in the summer. Price action's broken out. Looking at the personal products area, we did set a 52-week high there. Procter & Gamble is trading higher on a relative basis, but the group has been lagging. But Procter & Gamble is sitting, you know, just recently hit probably a 5 or 6 month relative high to the S&P 500. So this one's not bad. I wouldn't be surprised to see a decent report coming out of Procter & Gamble. PLD, Prologis, this is in the real estate area. We did just make a breakout, AD line strong. Look at the relative strength. Everything lines up in this except the fact that real estate is just completely out of favor. So Wall Street likes the company. It just doesn't like its group. Will that lead to a strong earnings report? I think it probably will lead to a strong earnings report. I just don't know if it's going to matter. I think it could be like some of these banks that beat this week and maybe even gapped up and then sold right back off again. Market doesn't want, anytime you get any kind of movement to the upside, Wall Street uses that to unload and distribute. Philip Morris, down here near about a 7-month low on the AD line. Price action is okay, not great. Relative to the tobacco peers, it's pretty strong, but tobacco's been setting a 52-week low. So you got a fairly strong stock in a very, very weak group. I'll pass. PNR, Pentair, definitely strengthening here off of the low we saw on the AD line 3 months ago. price action we've broken out. I think volume trends look pretty good. The group looks strong. This stock relative to the group looks strong. I would expect a good report out of PNR, Pentair. So I'd be looking for better than expected news there. Regions Financial RF 80 line can't get out of its own way. Can't break above the June high. It's in the banking space. No need to say any more. Synovus Financial, same thing. Banks 80 line weak, can't get through the June high. Next. Synchrony Financial. Looking at this is in consumer finance. It did break above the double top here, June and September, so that was good. AD line, though, still struggling. Relative strength panels are slightly improving, not enough for me to want to own the stock. Travelers, so we got a Dow stock here. This has not been a good performer. AD line weak. You can see relative to its peers, it's been downtrending for the last 4 or 5 months. Relative to the S&P, near a 52-week low. I stay away. And that's it. Whew. Hour and 20 minutes. Well, I probably did it in about a little over an hour, maybe an hour or so, hour and 10 minutes maybe.
Wow.
So 102 charts in about 70 minutes.
Hey, Tom.
Yep.
I think we forgot to hit the record button.
That's
Could you
great.
just go ahead again?
Yeah.
What a fantastic job. Listen.
Hey guys, we're recording.
I'm making a joke.
Oh, okay, I was like, we're recording. Don't worry.
There's Abby. I wanted to put fear into Tom that he had to do it all over again. And you'd have to stick around for another hour and a half.
Yeah, Abby, this won't be the last time he says this. This joke's getting a little old.
Hey, Tom.
Hi, guys.
Yeah. Listen, you're hearing a voice of our customer service superstar. Anyways, Tom.
Yes.
Real quick, you covered enough charts, but I just wanted to talk about 2 stocks because I got a couple questions. After hours, Fastly warned, and so the stock, so the stock is down about 25%.
Wow.
Okay. Yeah. Now, on the other hand, yep. So you can see it's holding right at the 50-day. Somebody asked about that because that's in our. I think that's in our strong AD portfolio.
Yeah, it's not going to help, that's for sure.
No, but at the same time, I want you, when you're done with this one, I want you to look at NIO. That stock was up 22% today. It's up another 3% after hours. Mm-hmm. The point I'm trying to make, is that we see this all the time. You have a number of stocks and we have offset. The whole idea is to have more winners than losers. And so the question was if you could just take a quick look at these 2 stocks and then we'll wrap it up.
Yeah, well, I mean, I was just talking about NIO recently. I think it was on one of my shows earlier this week, and I said I love this flag that we're in. That's a bullish, normally this resolves in a move to the upside. When you see a move up and then sideways consolidation like that, that is a bull flag. So it's a move up, flagpole, flag to the side. You expect a breakout. We got in the breakout. I'm not at all surprised about this one. It's had great volume trends throughout, last several months. You can see the AD line's been strong. There's really, looking at it on a relative basis. First of all, when you look at autos, this has been the best area of the market, automobiles, over the last few months, maybe the last 6 months. It is actually over the last 6 months because I took a look at it. NIO is one of the best stocks versus the autos. So you've got one of the leading stocks in the leading industry group. You probably have the leading stock in the leading industry group. And so when we come out and we get good news, I'm not usually surprised by the good news. So yeah, I mean, I'm still a big fan of NIO. Fastly, our portfolios are based on earnings and valuations are based on future growth. I have not had a chance to look at the warning. That's the first I've heard of it. So I'd have to take a look at it, but it's not a good thing. Anytime you're warning, you're basically saying that we're not going to meet our numbers and therefore all of our future projections that are creating our value are probably going to have to be lowered. I mean, if it's a one-time warning where something happened this quarter, and they say, hey, for whatever reason, it's something's tied up in our product delivery chain, and these are just simply sales that are going to go in the next quarter, then we might be seeing an overreaction. But if this is something where they're coming out and saying, we're just not going to meet our numbers, we were way too optimistic, I don't think that bodes well for the stock probably in the near term. Now, another question that usually comes up is, should we have a stop then on the stock? Well, as John was talking about, no, we don't use stops. Doesn't mean you can't use a stop. We like to be very transparent in our results. We like our portfolios to be very simple in nature for people who are maybe working and are not able to follow stocks every day, don't want to follow stocks every day. So we started this with the intention that it was going to be a hybrid of trading, in the sense that we do replace these stocks every 90 days, but also buy and hold, in that we're not going to apply trading rules throughout the 90 days.
Mm-hmm.
We're just buying, we're holding. In some cases, we got to hold our nose. The last thing I'll bring up is that QDEL, earlier this quarter, took a big hit after we had announced, I think this might be in the strong AD, or maybe this was the aggressive. I think this was in the aggressive portfolio. But a news item came out, and it was Abbott Labs announced their $5 15-minute coronavirus test. QDEL, being in that medical diagnostic area, immediately took a hit along with all the other medical diagnostic companies. At the time, it felt like, oh my gosh, this thing is going to go to zero. I mean, it went from $225 one day to the next day, intraday, it was at $135. It was down $90. Look at where it is now. I mean, if we had a stop in play, clearly would have gotten stopped out on that drop. And now we would not have been in it for the recovery. I can't tell you what the right thing. Everybody has to do what they feel is right in their own portfolio. If you feel like, hey, I can't be in any stock without a stop, then put stops on them. I mean, we're giving our picks based on our research and based on the things that we look at. And, we provide that to our members, and some members buy all 4 portfolios. Some members might buy one of the portfolios. Some members might buy pieces of each of the portfolios. Some of the members may just trade stocks, and as a result may trade some of the portfolio stocks. It's all up to each individual. Everybody's different. Yep. And I will just say, there's no way for us to put something out there that's one size fits all, that, hey, everybody do this, because everybody's in a different position in their life, and they're in different financial positions, and they have different risk tolerance levels and so forth. So I always talk about us being more of a research platform and providing tools and education to help our members do better. We're not registered investment advisors. We don't tell any of our members, hey, buy this. That's not what we do. We show you charts. I might say, hey, I really like this because of this, this, and this. But then it's up to you, each individual, whether you want to buy it or not.
Okay.
Again, we can't go anywhere beyond that.
The last 2 questions real quick here. If you don't mind.
No.
This isn't a portfolio, been fantastic. Zoom, this is somebody's observation, body's observation, okay? Zoom's currently displaying negative divergence. Do you agree, and would you comment?
Zoom, this is one of our portfolio stocks. Yeah, I would absolutely say it's got a negative divergence. But does a negative divergence guarantee us that the stock is going lower? The answer there is no. One of the things that I would be looking for, it just broke out. Volume did pick back up again. It traded almost 10 million shares. So we did see a little increase in volume. What I might be concerned about is if we went down and lost the 20-day moving average, because if we do that with a negative divergence in play, I think that could lead to a 50-day test. And certainly I think everybody knows Zoom's been up a lot. So a 50-day test at some point is warranted. We saw the stock at the 50-day in May, and then it ran from 150 up to 280. So it ran up probably about 85, 87%. And you can see over the course of the next 3-4 weeks, we ended up making it all the way back down to the 50-day moving average. Well, we've seen another big move. Could we go back down to the 50-day? Absolutely. If it bothers you being in the stock with the negative divergence, then, take profits and move on. If you look back right here, we had it back in July before we had a 50-day test. Now, do I think it was a horrible move lower in Zoom because of it? No, but we did have short-term weakness. So if you're a trader, then yeah, I think that's something to consider. For me, I probably would be okay unless it broke down below that 20-day.
All right, last one. Would you consider using price performance versus price and relative strength, which keeps us from having to do the math percentage-wise in relative strength indicator panel, for example, SPX?
All right. Well, I'm going to pull up an individual chart so I can show the relative strength panels. Let's just pull up Zoom. All right, so the question, and I'll pull this up on a relative basis. I don't know if this is the same person that wrote to me because I got an email about it. I looked at it, and I don't know that I'm that concerned about using price versus price relative. I think price relative is going to come into play better if you're comparing one security against another. What I'm doing is simply looking at a chart and trying to decide if it's displaying relative strength or not. The price relative, and I'm going to try and pull one of these up and see if we can walk through it here. Or price performance here. Price performance, and let's look at symbol, dollar symbol, colon SPX, or yeah. So it'll be the same as this one up here, except this will be price performance. And then I'm going to move it up one. So these two will be side by side. In fact, I'm just going to get rid of these other ones just so it doesn't confuse us here. Let's just get rid of all these other. Even get rid of the accumulation distribution. All right. So when we're looking at Zoom, Zoom obviously has been going up. Now we're looking at, why didn't that come up? Let's just try it. Okay. And then I want to actually add height over here. Okay, so Zoom. Here's Zoom going up. Here is Zoom relative to the S&P 500. And then you've got the S&P 500. I don't know if this, maybe we need a clarification. Is this what they're looking for, showing the price performance of the S&P 500?
Yes.
Okay. I'm not really sure that it adds anything for me. I don't really know how to answer this.
Actually, you know what? A clarification is no.
Okay. I think somebody in the background is indicating this could be a dog of a chart. That was just supposed to be funny.
I got it.
So no, what is the answer? What do they want me to show? I don't.
Zoom versus the SPY.
Well, that's what I was showing. I mean, here's Zoom versus the SPY.
Okay.
I mean, are they saying on a price? I tried to do that and it didn't. Price performance, symbol versus S&P. Oh, okay. So there's the 511. Okay. So I think what the question is when you look at, say, Zoom, and you see Zoom on a price performance chart is outperformed the S&P 500 by 511%. If you go and you pull up, say, Tesla, and you do the same thing, Tesla's outperformed by 663%. And then if I pull up, UAL, you can see that it's minus 65%. So I think the question is just saying, would it be adding something if we used price performance on here as opposed to just the relative strength, just the price? And I don't pull these up to compare the strength of one company versus another. Maybe within the same industry group, this might make sense. So if I was comparing Tesla and NIO, then it might make sense. But if I'm trying to find a leading stock in semiconductors, and semiconductors have not outperformed the S&P 500 by as much as automobiles, I don't know that I'm comparing apples and apples. I think I'm getting apples and oranges. So I looked at this at one point. It's been a couple months back, I think, maybe a few months. And I just didn't think that it was anything that was helping me on that individual chart. Remember, I'm trying to compare, if I'm looking at Zoom, I'm trying to compare Zoom on a relative basis to using these 3 or 4 different panels. So if I go back in here to this relative chart, I'm looking at it relative to its industry group. Is it a leader? Relative to the S&P 500. It's got to beat the S&P 500. If it's not, then I mean, what am I really doing? If I can't beat the S&P 500, I shouldn't be in the stock. And then the peer group, I think, is important to know whether the peer group is beating the S&P 500. I don't know how to include the price performance. I don't know that it's telling me anything on this particular chart. I think it would only be telling me something if I was comparing 2 securities. So I can't, again, if you're trying to make an investment decision, I could see where you might want to change that and take a look. But when I'm trying to decide whether or not to put it on, say, the strong earnings chart list, I don't think it does anything for me. I can see whether or not it's outperforming the S&P.
Okay.
It really doesn't matter to me by how much. I don't know if that helps.
Yep. All right. I think we got to wrap it up here. Awesome job. Everybody get a copy of the recording. Tom, go get a beer on me.
Yeah, I do want to just point out anybody that came in late, just make sure you check out our webinar special. So go to the website, top of the page here, you go to webinar special. But essentially, we're starting an ETF service. And if you pay right now for an annual service, this is the fee it's always been, $697. But this will extend you out into next year. And it includes the ETF service that we will begin to separately charge for in January. This, if you sign up to an annual, you won't have to pay for the ETF service until you come up to your renewal date. So it could be 13 months from now. If you've already, let's say you have an annual and you already go out into next year and you want to extend it another 13 months, you won't pay for your ETF service until sometime in 2022. You'll still get all the service. You won't have to pay for it. It's by far the best special we've ever had.
Absolutely. And by the way, next event, model portfolio ETF unveiling next Monday. Got to be a member to be part of that.
Yep.
All right, man. Great job.
All right. Sounds good. Everybody have a great evening. Be back tomorrow. Take care. Happy trading.